Hello, everyone, and welcome to the very first ESI ThoughtLab and FinTech B2B Marketing's webinar session today on the topic Wealth and Assets Management 4.0, how digital, social, and economic shifts will transform the industry. We have got a terrific turnout today across the globe. So a very good afternoon, good evening, and good morning to everyone from wherever you are joining us today. My name is Kyle Rayner. I am founder of FinTech B2B Marketing.com, and I'm going to be your moderator and host for the session today. Over the next 60 minutes, we are going to be looking at some of the key megatrends disrupting the industry and the future of wealth and asset management today. As you may know, ESI ThoughtLab, a leading research and economics firm, is conducting a pioneering research program for Wealth and Asset Management 4.0, which will explore how COVID-19 and other disruptors will change the investor perspectives and provider strategy. I am absolutely delighted that I'm joined by an all-star panelist today, which I'm going to introduce to you in a moment. But before that, just a couple of housekeeping activities. We would love to hear from you. So you probably can see a question mark icon on the side of the panel. So it's a very much a live webinar, and we would love to hear your thoughts, and we'll try our best to answer your questions in the limited time we have got. So please use that. Also, there are some super interesting resources available after the webinar, so don't forget to download that. And lastly, if you do need to pop out to grab a coffee, or you might have to jump out for a meeting, this session is being recorded. So you all are going to receive a recorded version of the session in your mailbox, so you can view it at your leisure. So with that, let me introduce to our fantastic panel members today. So looking at first on my screen, I've got Ronen Assia, co-founder and executive director at eToro. So Ronen, for more than 20 years, has been working with emerging technology and design to create products that perform across multiple platforms. And prior to co-founding eToro, Ronen designed medical devices, household appliances, and desktop and web applications. So welcome, Ronen. It's great to have you on board.
Thank you. Happy to be here.
Great. Next, we have got Lou Celi, CEO for ESI ThoughtLab and Program Director for Wealth and Asset Management 4.0. So Lou has been founded the ESI ThoughtLab company in 2014 to create a visionary thought leadership that sits at the intersection of economics, technology, and management strategy. And Lou has nearly 40 years of experience as a corporate leader, author, speaker, entrepreneur, and consultant. So welcome, Lou.
Thank you, Pale.
And then we have got Andrew up on my screen here. So Andrew Diana, Senior Vice President, Retail Customer Experience, Operations and Planning at Charles Schwab. So Andrew's role is focusing on shaping the future of firms' retail, wealth management, and brokerage businesses. And since joining Schwab in 2015, Andrew has led strategy, planning, and client experience teams within investor services and marketing organization. And Andrew recently led Schwab's efforts to integrate USSAA's investment management company. So it's great to have you here, Andrew.
Honored to be here. Thank you.
And we have got Gauthier Vincent, lastly, lead wealth management consulting partner at Deloitte. So Gauthier has been leveraging 20 years of experience in financial services as a consulting partner, an investment banker, and a private banking executive. And Gauthier oversees team that works with leading wealth manager to design and deliver compelling digital experiences for clients and advisors to transform their technology platforms. So welcome everybody. It is absolutely an honor and pleasure to have you on board, and I promise all our participants and delegates today to have a very insightful session which you can take back some really good insights back home following these 60 minutes of our live webinar today. So before we jump into the actual questions, Lou, perhaps it might be great if you want to give a little bit an overview to our participants today about the report ESI ThoughtLab is running, and share more details on that.
Be happy to. So it's a pleasure to be here today. And let me tell you a little bit about the study we're doing. If you go back to the earlier slide, Payal, please.
Yeah.
Okay. So the purpose of this research is to understand the future of wealth and asset management. And as we all know, the pandemic has been a watershed moment for the world, and particularly for the financial industry. The pandemic has accelerated digital and social and market shifts that were already in motion, but these shifts have been heightened by a year of social distancing, and in creating what we see as a new normal for the wealth and asset management industry, what we call wealth and asset management 4.0. And we think, like a lot of other industries, there's a revolution going on in the wealth and asset management industry that's going to bring digital and physical and even social change together to reinvent the marketplace. And in that, we see 8 major megatrends that are giving rise to what we call wealth management 4.0. And one of them is the rise of digital, where digital becomes the norm for the industry. The industry becomes digital first, and just about anything within a wealth and asset management firm that can be digital will go that way. We also see investors resetting their expectations, and these are investors across age levels and wealth levels that have been affected by digital and social changes. The future of work is now. What we see is shifts going on in the way that work gets done, even where it gets done, and the impact of how even the location of businesses and branch offices right now going through great change coming up, and we want to talk about that today. We have firms that are rethinking their growth plans, fintechs that have gone upstream, and incumbents going downstream and getting more involved in robos, and reaching, understanding their positioning. So that's another very big trend. Social values driving decisions is an enormous shift that we see in the future. In fact, a shift of capitalism moving from shareholder capitalism to stakeholder capitalism, and institutions not giving lip service, but actually changing the way they go to market and even think about their products and services with an ESG lens. Even before the pandemic, value propositions were changing. There was pressure on margins and fees and need for transparency. And as we move into a post-pandemic digital age, that's becoming even a broader trend. The playing field itself over the next few years could radically change. We know some of the panelists even have consolidated and acquired organizations. We think the future of fintechs over the next few years could be a force in the industry. In fact, we're even seeing organizations outside of the industry, like Alibaba or Walmart, getting more involved in financial services. So it's very interesting to see how that will play out. And of course, there's the shifting regulatory landscape. And that's happening around the world with shifts on everything from know your customer to, work in the best interest. And of course, you add to that some of the tax changes, particularly here in America, where you've got a shift that's likely to go on over the next few years, and a tightening of regulations in America too that will affect the industry. So there's a lot of change coming, and our view is that this change is going to happen more quickly than it would have because of the pandemic. So that's the reason that we're doing the study, to really explore these changes and what they're going to mean for your customers, for corporate strategies, and ultimately for the need for speed in digital transformation. And so if you go to the next slide, Pale, I just want to let you know that this is part of a broader wealth management program. So all of you that are listening today, you will have access to a lot of the research that we are doing, and that research being sponsored by Deloitte, eToro, FIS, and others. And you can find all the sponsors on our website who are funding the research, but working with us to do a global survey of 2,500 investors all around the world, and 500 wealth management firms across the industry, from private banks to universal banks to family offices, to find out exactly how investor expectations are changing and how wealth management service providers are going to be adjusting to those changes. And so that's a key part of our research. That research is being done as we speak. We hope to finish it over the next few months and be able to report back some of the key findings. Our economists will be doing gap analysis, leader-lagged analysis, and ROI assessment to understand, where are the gaps between what investors want and what providers are doing, and what are the leaders doing that the laggards can learn from, and how are these investments in the future of the industry affecting their performance. So all of that will be work that we will do and will provide back to everyone's listening in the broader community. We plan to be doing interviews with wealth management executives and experts, and we welcome open participation from anyone listening. This is the first of a series of webinars. We will be holding a number of webinars as we filter through the research, and we'll provide out our key findings through social media and other updates. At the end of this process in October, we plan to have an ebook with think pieces and infographics that will tell you all the full research findings. And all of that will be available on a wealth management microsite that we set up specially to house all these thought leadership assets. So, Payal, if you want to just move to the next screen. ESI ThoughtLab, as you know, is a research firm. We specialize on technology and its impact on financial markets and business and government. We'll leave this on Bright Talk, so if you need to get in touch with us, would like to participate in any way in the study, we'd love to hear from you. And I think with that, Payal, back to you. Payal, we can't hear you.
Oh, sorry, apologies. So yeah, no, great. Thank you so much for that insight and sharing those 8 megatrends. That's super useful. I guess my question here is, why is this research so timely and important now? Like, why now?
Well, I think the pandemic has been a watershed moment for the world and for the industry. I think there have been many changes going on, the rise of digital, social awareness, even rebuilding the economy. And I think this is the perfect time to take a pause and look at what these trends are going to mean for the industry. We track the industry every year, but I think this time we're going to be seeing fundamental change, so that over the next 3 to 5 years, it's a very different world. And why we need to do it now is that these are trends that many of our clients, like Schwab, eToro, others that are around the phone, need to think about now. Before the pandemic, you could maybe wait a little longer, but at this point, it's urgent to understand exactly what investors are thinking, what they need, and organizations responding pretty quickly if they want to stay very relevant in the next era. That's how we see it. Hale, we can't hear you.
You're on mute again.
Sorry, apologies. That's brilliant. That's great. As I said in the beginning, this is very much a live interactive discussion. So it would be great to get thoughts from our audience and participants today. So we will be starting a poll before we get our experts to give their thoughts. So which of the following market trends will have the greatest impact on the wealth management industry over the next couple of 1 to 2 years? So I hope everybody can see the polling questions up on their screens. And we've got some options listed there. So do you feel it's new market entrants like fintechs and insurance firm, or changing digital expectations of investors, shifting regulatory and tax environment, lower operating fees and operating margin compression, and lastly, new working behaviors such as remote working? So please use your polling buttons. We have got a few seconds left, so we'd love to hear your thoughts and see what everybody thinks in terms of the biggest impact they feel on the wealth management. I'm going to be ending the poll now in a couple of seconds, so use your final votes now. So I'm ending the poll now. So I think we've started getting some initial results here. So 66% feel the numbers are moving, so I should just give it a minute because it's a time delay.
So why don't you keep following that? And meanwhile, why don't we hear from some of our experts around the table what they're thinking? And then we'll see how that reconciles with what the audience is thinking. So Gauthier, why don't we start with you? I know that at Deloitte, you are looking at various trends that are affecting the wealth marketplace. What would you say is the biggest 1 or 2 trends that you see that will transform the industry going forward?
Sure. Thank you, Lou. I think it's hard to argue that the biggest trend is not the change in digital propensity that we see across all wealth tiers, all customer segment or client segments, and digital expectations in terms of digital experience expectations that investors and advisors have, right? This is transforming the industry. That has been that trend has been transforming the industry for several years. As you said, COVID has accelerated it. But this is actually driving the trend towards upgrading pretty much the whole technology platforms that wealth management operates on. I remember a discussion with the CEO of one of the big wirehouses a few years ago, right? And the discussion was what do we do here? How do we create this scalable, digitally enabled, modern wealth management platform of tomorrow? And that's a 10-year transformation. And the transformation is driven now by the front office, by the need to create those compelling digital experiences for clients and for advisors. And it has implication through the whole platform, front, middle, and back office. right? So this is a 10-year transformation. It has been underway for a few years. COVID has accelerated it, but at the end of the day, what is really driving that is change in digital expectations and the technologies that enable, make it possible to build those compelling experiences.
So Schwab, so Andrew, you work with Schwab as the strategic visionary, and Schwab, I always think of Schwab as one of the firms that are the most advanced in digital. I mean, you always push the envelope. What do you see over the next few years for Schwab? Where is digital heading? And do you agree that it's a big game changer?
Yeah, I think I'll certainly agree with the points that these are trends that have been in place for some time, and we're now seeing an acceleration in those trends, in particular as the pandemic, out of necessity more than anything, has driven just a massive step change in digital adoption, comfort with digital, in places that I think we've collectively as a firm been surprised, where older investors have become more comfortable engaging digitally, and even in places that are more personal and emotional experiences, like the act of giving advice, like moments in critical life events, like the death of a family member. We're seeing clients willing to engage digitally in ways that they hadn't in the past. So certainly a step change. As you said, at Schwab, I feel like we've been several years in the digital transformation that GV mentioned, and it's certainly an important priority for us. Listen, I think we believe the adage that the last best experience anywhere sets the minimum expectation for experiences everywhere, which really is putting a lot of pressure on financial services firms to keep up with the Amazons, the Googles of the world, in really creating personalized experiences that really send the signal that we know you. We're using what you have told us effectively to customize and personalize the experience for you. An expectation for easy experiences, that when you're opening an account, when you're selecting a security, that we've really been thoughtful about the user experience and made that as easy as possible. And then finally, the notion of omnichannel, I think, is taking on new meaning, and the expectation that clients will be able to seamlessly move not only from mobile to desktop, but from branch locations and the service center without skipping a beat and without losing any information about what we know about you and how we're serving you.
It's an interesting point that you bring up, particularly when you think about Amazon and how far the Amazon model can stretch to wealth and asset management. And I'm wondering what you think, and we can maybe hear from Ronen, who's our resident FinTech executive first. But the question is, how far will it go digital? There's a pendulum in wealth and asset management, particularly unique to the industry, that you have high tech and high touch. And there are a lot of high touch people. Some of them are in my family even, who think, at the end of the day, everyone's going to want to talk to another person about wealth. And at the end of the day, regulators, it's a complex regulated industry. So there's a limit to what you can do with machines, right? So and Ronen's shaking his head, maybe there is no limit. So what are your thoughts as a FinTech? And then we'll come back to Gauthier and Andrew to get their views.
I think purely, while the reason I was nodding my head is because I think if you really think about it deeply, it's so much easier to regulate machines than it is to regulate human beings in terms of
Right.
compliance requirements. And I see, I'm exposed to so much technology that's up and coming, that's only about sort of organizational surveillance system to keep track of all of the chats in the organization and the emails and the paper trace, and this is all.
That's true.
This would be so much easier if it was all machine controlled. So I think just if I was a regulator, I would push everything to go more digital rather than less, because it's way easier. It presents other, there are other debates, maybe not for this conversation, about the use of AI and other interesting technologies and how that can create other challenges. But I think overall, there is no reason.
Well, you're right about that, Ronen. You're right that digital and technology can really help with regulatory compliance, and there's even sponsors in our committee that do that ongoing. And I think you're right. I guess what I was referring to more was things about acting in the best interest and looking at, some of the problems that happened with Robinhood, for example, and whether machines can always act in the best interest or whether you need people to get involved. It's a more provocative kind of question.
I think it's always about, of course you need some form of human supervision, otherwise we'll go the Terminator route here.
Right.
And nobody wants to go to that dystopian future. But I think it's again, it goes back to how easy it is to regulate something once it's completely digital. And I think regarding your first point, that sort of fintech or financial services Amazon moment, I think everybody agrees, unlike other domains, financial services is not a winner takes all game. So it's always going to be about lots of different players coming in from different target audiences, different demographics, different geographies, different products, different services. We're not going to see like a dominant one Google, one Facebook, one Amazon to rule this entire industry. There's just too much, way too much types of services, too much, client demand, and then also a lot of regulation. So I think unlike in other areas where it's sort of developed from the ground up, if you think at other technological phenomena here, this is already an industry that's up and running for hundreds of years. So some of it might have been gone digital, but it's not something that we've created over the past couple of years from scratch.
Gauthier,
but if I may add right to what was just said, just to comment on a couple of points. That to oppose human and digital, I think it's false, right? It's not human versus digital. For me, the best example of that is we all know trust has been at the center of wealth management, right? Nothing's happening in wealth management without establishing trust. And everybody knows that trust relies on human. But human what? It doesn't mean necessarily two human beings talking together. It means treating the investor, the client, as a human being. And sometimes digital is the way to treat the client as a human being. For instance, in times of volatility, the firm needs to react and contact the client right away. It needs to be real time because the client has emotions. The client is a human being with emotions. So volatility in the market, you need to interact with me. If it's too slow for an advisor to pick up the phone and call his or her 200 clients, do it digitally. So digital tools make the interaction and the engagement model much more human and build trust. So it's a false opposition to think it's either human or digital. And
right.
The point that Ronen made about financial services is not a winner takes all market, right? It's a very interesting point because it's true, right? We see a number of firms out there, and the competitive dynamics keep changing on us. But I think there are a number of firms, and our friend Andrew is from one of them, that I think have the strategic clarity, the consistency in terms of transforming the wealth platform, and the scale that I talk to a lot of the competitors, they're all scared. Right. So, and I could mention a few other firms, right? But there are a few firms that have the investment in the technology, the clarity of vision, the consistency, and the scale that make them formidable competitors. And it's a little scary for the others, I would say.
And I can see some questions popping through our chat channels as well. So I guess one of the first question which ties into that conversation is, how does the digital expectations of clients differ between retail versus institutional investors? So that's a very interesting question. Andrew, do you want to go for that one?
Yeah, I'd love to. I'd be happy though to pick up a few of these threads before I get to it though, because I think there's some really interesting content here on a couple of the pieces. Maybe first off, I couldn't agree more with you, GV, on the importance of trust in this business. And I think we see very substantial growth on both ends of the spectrum between high touch and human and also digital. I think that's illustrated through the growth, by looking at the growth of the RIA channel, for example, which is, truly the kind of traditional advisor model that we're seeing outperforming in the U.S. in terms of asset growth, or at least keeping pace with other channels. I think for me, and I think Schwab's core belief is that the winners of the future are those that are going to create no trade-off approaches. To use your phraseology, Lou, the kind of no trade-off between high touch and high tech. And firms that are able to deliver upon client expectations when they're looking to be in the driver's seat, controlling their portfolio, making choices on their own, planning on their own, but also have the capabilities as they mature as investors, as their needs change, to be able to be there with human advice to help clients through moments of important life events or market volatility when, as you said, clients are looking for a trusted voice to help them navigate choppy waters. So I think firms that are able to do all of that in one place are going to be those that are going to grow and scale in the future. And I think that is a big part of why we're seeing consolidation pressures in the business. And when we look out into the industry and I talk to peers, why many of them are fearful is being able to either starting at one end of the spectrum or the other, being able to converge on a really hybrid model that is able to bring the best of both human and technology together. It's also added to by the price pressure that scale helps large firms compete against, given how important price is in our industry. And I think we believe strongly that the future will be large platforms that are able to deliver that scale and ultimately deliver on those price expectations that client has. It doesn't mean there won't be a flourishing place for the fintech community that we have today and see in our business and around the world. I think my view is that will largely be in helping us drive innovation and really pushing the envelope on what we can do. And for those ideas that really flourish and win, those will be incorporated into those larger firms that have been able to build the scale.
Interesting. So I guess, Pale, you had what did the poll say actually?
So looking at the polls again, then it resonates with all our fellow panelists are saying here. So only 18% felt it was new market entrants like fintech and insurance firms were had the greatest impact. So I don't know if any results surprise you, because I know, Lou, you were talking about the future of work, and new working behavior is bottom on the pile here.
Do you have? I can't see the list right now. Is that something that you put up on the screen?
I think there's an icon on the right-hand side.
It's an icon there. The poll, if you click on that, you should be able to.
Oh, there it is. Okay, I see it. Yeah.
Yeah.
Perfect. Thank you.
I'm disappointed the speakers don't get to vote on this poll.
Mm-hmm.
Well, you get to vote right now, Ronen, because what the poll is saying is that 54% think it's about digital, so they're agreeing with what this team is saying. They think that fintechs, insurance, and other market entrants are disrupting, and we might want to talk a little bit more about the future of fintechs and that disruption, because it's true. A lot of these digital trends are being explored first by fintechs and then used by incumbents. There is a view about 9% that think regulatory and tax environment will have an impact, and it'd be good if this team could comment on that as well. And then, of course, there's the margin and fee compression that Andrew was just talking about, which some people are saying will be a disruptor, and also working behavior. So the big story here is digital expectation is the big game changer, followed by new market entrants. And then regulatory and lower fees and working behaviors will also have an impact. Make sense, Gauthier?
I think it does, but some of those trends are not independent of each other. For instance, digital expectations clearly is driving a lot of the transformation that we see here. But if you do simple math, right, and all the senior executives in this industry have done the math. So if you lose something like 50% of your pricing power over a number of years, you need to double the productivity of your advisors to just keep even in terms of bottom line. And for that, you need to digitize a lot of processes and create the digital experiences that will provide leverage to your advisors, right? So that they can serve more clients, serve them better. right? So those two trends about pricing and about digital are not independent of each other. They actually reinforce each other. They play on each other. And the other comment I would like to make about the competition, the point about new competition, right? I think there are probably divergent views here. My personal view is that what is really disrupting the market, it's a slow trend, but it's happening, is the convergence of consumer finances. And I see, we've been saying that for years, but we are starting to see it. It makes no sense for me as a customer to have a financial plan with my bank, with my wealth provider, and with my insurance company, right? It's fundamentally not efficient. And so insurance companies moving into wealth management as a way to add more value through their distribution channel. Banks, retail banks, and wealth management, if you look at some of the largest banks, are converging fast with advice at the center of the relationship between a bank and its consumers. So this convergence of banking, wealth management, insurance, I think that's what is driving potentially new forms of competition. I think more than fintech, in my view, fintech are being co-opted into the model, as Andrew said earlier.
Yeah, and building that quickly, you referenced Amazon earlier, Lou, and kind of the probability of getting to kind of an Amazon-like dominant player in the business. And I think if there was one future state that could get you there, it's exactly what you're talking about, GV, of from which direction a firm is able to kind of bring those different diffuse pieces together in a single platform that enables banking clients, investing clients, insurance clients to really see that holistic view of their life, and whoever wins that race is going to be the winner of a lot in our business.
But it sounds like, I mean, when we talk to some of the banks that we speak with, some of them have a platform model in mind, and it basically goes that. And there's one in France, for example, we talked to, and they have a very big operation, and that is a full service bank. And then they bring in smaller banks that can tap into it, like the mothership. And so they're creating their own little ecosystem and platform that that can support smaller operations that want to play off of their strong capabilities. And then I've heard from other organizations that there is a play even for the Alibabas and the Amazons, because that was always, the gigantic gorilla in the room. Will that go that way? And people say, well, the regulations are going to prevent that from happening, but it doesn't prevent partnerships. It doesn't prevent Walmart from teaming up with a fintech and offering solutions. It doesn't prevent Schwab from, teaming up with Amazon and being more the financial arm behind it, right? And so those are other disruptive big trends that can happen. I'm just curious what you all think.
I can offer a comment here, right? Here we are guessing about very long-term trends. When I talk to banks, for instance, the nightmare scenario for banks would be to lose the client relationship function, right? To lose it to some large fintech firms, right? Who would position themselves as owning the client data and owning the client relationship, and letting banks do only the manufacturing of products, the provision of credit and asset liability management, right? So that's one scenario. When you do scenario planning with the different firms here that we're talking about, that's one scenario. But I think it's pretty remote.
Okay, moving on to some. Okay, sorry, Ronen.
No, I think I will offer maybe a slightly different opinion. I think what really from my colleagues at the banks, what I hear is that and that's sort of a trend that's been going on for the past decade or so, that what used to be coupled between I call it the holy trinity of regulation, operation, application, which used to be very tightly coupled into one, is completely breaking apart. And so suddenly you have lots of both technical as well as operational and regulatory capabilities to build applications on top of somebody else's infrastructure. And that is, somewhat, I think, concerning for big banks because they see themselves as ending up without the client relationship. And really, people pay very little today for infrastructure like, I think in traditional custody, it's down to less than 1 basis points. So, fee compression is completely wiping out what used to be like traditional businesses. And so I think lots of, where the banks sit is that we see over time, and that has really accelerated over the past 2-3 years, more and more services getting commoditized by fintech players. So you don't need, 100,000 people working at a big bank to offer, regular checking account or a debit card. That's like already plain vanilla. What you do need the banks for, I think, is for very specialized, if I have a big company doing something very specialized and I need some, a special credit line or a special facility for trade financing or stuff like that, that's very, manual by nature, then I'll probably need a big bank or a big financial institution. But I think as we go throughout, the past couple of years, we see more and more what used to be like traditional financial services getting completely commoditized. And I think that's also reflecting on the previous point that you made regarding how crucial trust is within financial services. And that's also changing because younger generations, unlike maybe my generation and generation above me that used to bank where their parents banked, that's no longer the case. So suddenly younger generations, if Apple is offering a bank account, guess what? They're gonna win a large audience because younger generations tend to, just the brand affinity is so much stronger with some of these tech companies, and they don't really care. It used to be, you used to have this very nice logo that said, Bank X established 18 something, and that used to be a good thing. And now people look at it and say, wow, it's 150 years old, this institution. Maybe they're drowning in legacy, and I should go for something that's more tech in nature. So I think there's lots of shifts across that what used to be like traditional value chains, which makes us think about how will this world look like, 5-10 years from now.
Hey, just picking up on that trend quickly, I think one topic we haven't covered yet around where investors and clients are looking for information and trusting information is the role of social media in driving a lot of investor behavior. I think we obviously all across the industry saw what happened earlier this year with GameStop, and I think we're surprised by both the degree of sophistication of information available in the social media sphere, but also the power of that information to really mobilize large amounts of retail capital. I think we estimated retail investors made about 25% of total market volume at the peak during that phase. And so I think it's probably too early to know if these trends are permanent, but that rise of retail investor and that role of social media is going to be a very interesting trend to follow.
So the one other trend here that we haven't really talked much about is new working behaviors. And that's, obviously remote working during the pandemic. How many people are going to go back to work? Are we seeing the rise of a hybrid way of working? Is that going to change the way RIAs work with their clients? Are they going to become bionic advisors? What is your view about the future of work for the industry and how that's changing? I mean, Andrew, you're probably thinking about this at Schwab as we speak.
Yeah, this area is one that is moving rapidly and is a pendulum swinging. I think if it was 6 or 8 months ago, I would have said much more confidently that the return was going to be far more in favor of remote models and more flexibility. I think now, as we're seeing firms make announcements about their plans, as we're thinking through our return to office plans, I think we're going to see a full spectrum, but with a lot of concentration in the middle, which will look something like still a high concentration of workers in offices in branch locations with a much higher expectation for flexibility for when and how they're in the office. At the same time, some meaningful growth of the force that is fully working from home. And I think in our business, some greater flexibility down the road around the ability of registered reps in the U.S. to also work in more flexible environments. I think we're hopeful to see from our regulators as well. I absolutely agree with you on the point of the impact on the client experience. I think we've been very surprised to see how comfortable clients have been engaging with our reps virtually through mediums like Zoom and WebEx. And while we're not pulling back in any meaningful way in terms of our presence in the markets, I think that notion of a bionic rep is going to be one that is accelerating here, with an expectation that clients can meet with you virtually online, can engage with you digitally through other channels. But when they want to meet you live, that you'll be there for that as well.
Yeah.
Perhaps to build on what Andrew said, right? I completely agree about the pendulum swinging. But for instance, a lot of our companies now, right? Because of the digital transformation, think of them as becoming more and more product management firms, right? And you think about creating digital products and with agile methodology, right? That's part of the transformation, trying to create this digital DNA in the firms. Well, as part of this digital DNA, for years and years and years, we have talked about the importance of co-location of multidisciplinary teams to create enough creativity and come up with the right experiences, right? That has not disappeared. And I think when we talked to different firms, right, everybody adapted very quickly to the pandemic, to working remotely. But now, a year later, we see the things that have been falling through the cracks. And the productivity in some cases coming down, right? The creativity coming down, and then issues around how do we train younger people, right? And then senior executives saying, but how do I create the right culture for my enterprises? Everybody is completely dispersed, right? So I completely agree with what Andrew said about the pendulum swinging. 6 months ago, you would have got a different answer. But I think, I think it's a rule of life, right? When people say everything is different now, you short this future, right? You have some change, but it's never fast.
Yeah, and so Pale, are we doing a good job answering everyone's questions? What's coming in from your side?
So just conscious of time, I hate to kind of interrupt the discussion. It's really intriguing and interesting. So our next polling question, that probably is going to be very interesting for our participants again here, to say how our investors' needs, expectations, and behaviors are changing because of the pandemic and other developments in the marketplace. So the polling questions are open for participants to poll. So we have got a few options here. So more personalized and holistic services and support, wider range of investment opportunities, greater focus on ESG investments and issues, new pricing structure and higher transparency, or lastly, digital access tools and experiences. So everyone has got 19 seconds here, and so you have to use your voting. And it's great though, because you've got a number of questions popping in through our chat panel as well. So it's super interesting to see that everybody is engaging and have got a lot to comment and give feedback to.
Okay, so what we'll do then is we'll go over these polls and get some views from you all in the group, and then we'll try to pick up on some of those questions, okay? So as the statistics are coming in, this is kind of interesting. The early statistic is showing a greater focus on ESG investments and issues, pretty dominant, as a dominant trend among investor needs, expectations, and behaviors. Those numbers may shift, but why don't we talk about the focus on ESG investments? Because it seems like a very rich topic. It seems like we really are moving into a more socially aware world, investing for purpose. There's a lot of issues, of course, about it. It's not just about coming up with new products, but making sure you're really investing in the best companies at ESG. I think it's going to go beyond funds and ETFs. People are going to be expecting this analysis for every one of their investments in all stocks and bonds. It's going to be something which a lot of institutions, I'm assuming like Schwab, is going to build into your outreach. And in fact, it's going to affect people's decisions on who they work with. They're going to work with greed is good is no longer the mantra. It's about investing for purpose. That's the trend that I see, but I wonder what you all are thinking. And that seems to be somewhat of what we're hearing here in the poll. Anybody want to jump in on their views on the ESG trends?
I think, can I go? Sorry.
Yeah,
Go for it.
plus, sure.
I think from my perspective, and we've been hard at work doing this for eToro. For us, it was always about making information very accessible, sort of, that grand theme of democratizing wealth management, because we have the social capabilities baked within the platform. So that gives the power of all of the users to discuss with one another. So we see that, ESG has become a very, hot topic over the course of the last couple of years. And I think that's where our investors actually talk to one another. They want a much better familiarity with, the companies that they're hopefully buying. And I think it creates a more, for us at least, it creates a lot of sense, because it creates a very sort of customized experience, where sometimes the traditional sort of vehicles, purposely built ESG focused ETFs, where you can't really change anything because it's so rigid. For most of our investors, that's really, empowers them to really take these types of decisions to a more customized and tailor-fit purpose.
But it seems to me that we're still early days in this. And then if you really do believe that we're moving to, more inclusive capitalism and investing for the good, common good, that what financial institutions are doing, and the agencies like Morningstar to do the measurement, has to tie into the way that companies are doing their own metrics, and would have to tie into what the regulators want, which is actually changing around the world, even the way they define it. So what are your thoughts there about what the industry needs to do to really do a very good job on ESG and to deliver on this promise, which we hope is not lip service by the industry, but truly thinking about investing with purpose? What are your thoughts there?
Well, if I may, a quick comment on that, on the previous question, and then I'll come to your question. This is a broader trend than even ESG. I remember the late Harvard professor and philosopher Paul Tillich used to say that that the dominant anxiety in our modern times is the anxiety with respect to meaning or lack thereof, right? And you see that popping up everywhere, and ESG is one manifestation of that. People want meaning in their lives, in everything they do. So you see that when you talk to a high net worth client, it's about legacy. And you see that when you talk to more mass market, mass affluent people, and they want to invest the right way, right? And they want to do the right thing. So ESG is rooted in a very fundamental and structural trend there. Everybody is looking for more purpose, and that's a response to a certain anxiety that we have in our modern societies. So that's I think what is driving this, right? On ESG itself, right? We have been talking about ESG for many years.
Mm-hmm.
The debate that has been raging and never answered satisfactorily is whether, if you invest in an ESG product as opposed to a non-ESG product, there is a trade-off. And intuitively there is, right? But that is the big question out there, and I think that's one of the reasons ESG has not taken off yet as much as we thought it would. Because intuitively, if you set up constraints around your investment policy, by definition, you give up a little bit of return. So not everybody likes to say that, but I think that's one of the reasons why the big wave of ESG has been a little slow to form. I think it's there, it's happening more and more, right? But it has been a little slower than what most people expected.
Okay.
I recall just a couple of years ago when the ESG topic started to pop up, then some of the professional market screener applications started adding ESG features, and you would open it up and it had like 3 or 4 checkboxes. So no weapon manufacturers, no tobacco, no alcohol, or something of the sort. Now you open it up, there are like 200 checkboxes. So it's still like a big debate of what goes in that huge umbrella we call ESG, and people are, society is adding more and more factors into it. So
That's
I think,
right.
Jury is still out. It's definitely a very important discussion, but there's no, we're very far away from, this is the industry standard and this is how the world will shape into.
Yeah, but I think it's going to go that way because I think that at the end of the day, it's about consumers and customers. And I think a lot of consumers care about the environment and green and social issues. And I think even the companies, the products they offer, the services are going to have to move in that direction if they're going to keep their employees happy and their customers happy and even the regulators happy. I think it undeniably has energy. But why don't we talk about the other thing here, and then Payal, you might have some other questions we want to ask. Just one thing we should talk about, since it came out high in this survey, is personalization, holistic services and support. I think that's what Gauthier was referring to partly too when he talked about organizations being able to meet multiple needs, not just investment needs. Anything that you want to say, Andrew? I know Schwab is doing a lot of cool things to personalize. And you want to talk about where that's going?
I think I would just draw the connection between these two topics, and I think make clear that personalization has a lot to do with enabling clients to really express their values, express their own views on the market and the themes that they believe are going to be driving growth in their portfolio. Enable them with tools to do that more effectively. ESG is a big part of the ability to influence your portfolio through those and impart your values on your portfolio, but it's only kind of one of several dimensions that I think is going to be the future of the business. Some of the big gaps that are from where we are now to the future of a more personalized state, I think for me come in a couple of dimensions, maybe starting with ESG. I think one we've talked about is going from a world that's binary, either ESG or not. I think we can all remember not too many years ago when really the only tool investors had was the single indicator from Morningstar, is this SRI or not, which was a kind of definition, binary on off. I think the future is clearly a lot more nuanced than that, with information and data being the key to enabling investors to make their own choices across the full spectrum of interest areas of each of the letters in ESG and beyond. I think the other piece is it's going to be far fewer off-the-shelf canned solutions, if you will, that are this is the ESG product, this is the non-ESG product.
Yes.
And more of a world of traditional products that may have a ESG tilt in one direction or another based on your individual preferences, and maybe most importantly, the tools that I talked about in the beginning, enabling investors to really incorporate their values as they're making choices, either it be for individual companies selecting ETFs or other securities for their portfolio.
I know we have very little time left, Payal, so I'm going to turn it back to you.
A couple of minutes left, and I can see lots of audience question popping in. So maybe we can take a couple of questions here. So one of the questions is about what is the future of measuring ESG impact? How much will investors expect to know where and how their investments are making a difference? So maybe Andrew, do you want to continue?
Yeah, I think I'll just quickly build on what I just said. I think they'll expect to know a lot. I think they'll expect to be able to cut the data and look at it in a lot of different angles, because they're going to bring their individual values and interests to, and that will be the lens that they'll look at it through. And it will be insufficient to have very general, generic indicators.
I think they're going to want to know it by company, and I think they're going to want to know it into not just the first tier, but the second and third tier of their supply chain. I think it's going to be very important for them, because if it turns out that the suppliers are doing something bad, I think investors want to know that. It's going to have to be deep.
Perfect. So that's great. We've got just a few seconds remaining. We are literally kind of touching the clock now. So how exactly can the more traditional wealth managers compete with the low-fee online services? What will make the fees worth it?
It's a good point. Good question. I'm going to give that to Gauthier, because he's...
Yeah.
That's a loaded question. What I'll say is that surveys show that investors are willing to pay, but for value. So it has pricing need to be transparent and linked to value. And as long as there is value, for instance, value in advice, quality of advice, they are willing to pay a premium for that. But investors are less and less willing to pay for not much value.
That's exactly right. And millennials are very clear. They're looking very deeply and say, I could do that. Why would I pay for that? And so I guess the value is going to come more from the holistic side and the specialized advice. Is that what you're thinking, Gauthier?
It's coming from the quality of advice to a very large extent, right? And advice is this difficult concept, but we understand what it is when we see it, right? Holistic advice is add value to me, help me make the more emotional decisions and trade-offs, right? Financial lives are intrinsically complicated. So advice is a need out there, but it needs to be quality advice.
And what I find interesting is some of the asset management firms like Schwab and Fidelity are starting to offer that advice, right? And is it an add-on specialized service?
Yeah, I think increasingly across kind of what were traditionally discount brokers that really led with value are finding a need to build on more personalized experiences with live interactions and human advisors. And that's in large part response to many ultra high net worth clients that have come onto our platform, and in addition to that, just the evolution of client needs as they mature as investors and being able to serve the full spectrum of needs all in one place.
Have time for one more question, Pale?
Okay, last one. So how much does trust play a part in those partnerships? Who do investors trust more with their money, banks or techs? I know tech trust you were talking about. Ronen, maybe, yeah.
I think it's very, very sort of age-dependent question. I think it really varies between almost every decade of the cohort of the population you can imagine. So
I think it's age dependent. Yeah, it's age dependent and wealth dependent.
Yeah. So it's I think generally, as I've said before, you tend to see younger generations have a much stronger affinity to either big tech players, new tech players, rather than going for the obvious sort of traditional institution. The older you get, the more bias you get for the more traditional players, and then of course it changes with wealth. And I think there's also, if you look at the past, and I think that's an interesting question, over the past 2 decades, people would spend, I recall a time where it was difficult for me to spend trust-wise $50 online. And now people open brokerage accounts completely online and sometimes deposit, hundreds of thousands of dollars. So that threshold constantly shifts. And so will we see a high net worth individual depositing, $10 million online completely? So I think that's sort of where the market is going, and then it's interesting to see the shift.
Yeah, I'll just add quickly, completely agree, age dependent. The common thread though between all ages, and I think both technology and human, is the element of transparency that GV you were talking about, and the ability for clients to very easily understand the business model, how you make money, and what fees they pay.
I actually think it's even beyond just wealth and level and age. It actually, occupation matters. If you're an entrepreneur, I found in Asia, you might trust technology more than you would a bank. There's a lot of variations. I think it's part of the whole how you understand the full client and their total profile.
But let's not forget recent history, right? 5-6 years ago, when we had all these new robo-advisors, everybody was interested. They had a really hard time getting clients to fund accounts, because at the end of the day, there was a gap in terms of brand value. And when it's your money, it's very close to your heart, and you tend to step back before you actually fund a new account or move assets. And the brand value that means sophistication in the investment world, in wealth management and all that, that is significant. It's very hard to build a brand like that from nothing.
Perfect. Guys, sorry to be the bad cop here to kind of say time. Apologies. But I think a big thank you to each one of you. Fantastic, contribution and input and insight. And thanks a lot for your for your time and contribution, and thanks to our fantastic participants. Just a quick, before we wrap up, just very quickly, about the FinTech marketing community. We are here to connecting and having those educational webinars to bring the FinTech experts together, and perhaps some of the dates for your diary. So it's great to see fantastic response for our very first webinar in partnership with ESI ThoughtLab, but we promise to be, more discussions coming down the line. So please make a note of these dates on your diary in June, September, and October, and we'll come back with our another fantastic panelist and host another discussion. But until then, have a great day, afternoon, evening, or your morning. So thanks, everyone.
Goodbye, everyone.
Thank you very much.
It was a pleasure.
Likewise, thank you.